Today we are going to learn about Bollinger Bands. We are going to learn what are Bollinger Bands. We are going to code a trading strategy based on Bollinger Bands using Python. And as always, the download link to our notebook will be in the description. We will code two versions of this strategy. One with a variable profit and stop loss and one with a fixed profit and stop loss. And we will learn about the returns of each of the variations of this strategy. And finally, I will talk a little bit about when the Bollinger Bands based strategy works and when it does not work and what are some ideas to improve this strategy. So let's jump into it. What are Bollinger Bands? As you can see here, I have drawn Bollinger Bands on Bitcoin data here, and these are the upper and the lower Bollinger Bands. The Bollinger Bands are simply points which are defined as the mean plus two standard deviations, which is the upper Bollinger Band, and the mean minus two standard deviations, which is the lower Bollinger Band. Now let's look at the price data here. So if we concentrate on the price data here, we will see that the mean value of all of these price points, or the mean of the middle values in our case, would be somewhere around here. And then the upper Bollinger Band, which is defined by the blue line here, is about two standard deviations from the top of the mean. And the lower Bollinger Band here is two standard deviations below the mean, which is defined by the black line here. So if you are not familiar with statistics, let's talk about mean and standard deviation. In our case, we are looking at the rolling mean, which means we are looking at the mean for the last n data points. And we can define n as a variable based on our algorithm. So the rolling mean is simply the sum of the last n data points divided by n. And then the variance is the square of the deviations from the mean for each of these data points. And if we take the square root of that deviation, which brings it to the same sort of scale as the mean, that is the standard deviation. So the mean plus two standard deviations defines the upper Bollinger Band. The mean minus two standard deviations defines the lower Bollinger Band. So why would we care about mean plus two standard deviations and mean minus two standard deviations? Imagine if these data points were in a normal distribution, which is a reasonable case in many places in statistics. Here you can see that the mean of the data is somewhere here, but in a normal distribution, it is well known that 95% of the data is within these two, within the two standard deviation limit here. So between the minus two standard deviations and plus two standard deviations, 95% of the data in the normal distribution is contained, which means that when this data is defined by a normal distribution, it is highly unlikely that the data will be above two standard deviations or below minus two standard deviations. And if that situation occurs, we can assume that there will be a reversal in the price because this price is highly unlikely. And that is the major rationale for the Bollinger Bands. Does that rationale work in our price data? To some extent, yes, it does. In fact, if you look at the places where we touch this Bollinger Band, we touch the lower Bollinger Band here and we take a trade here actually, and then there is a reversal of the price here. And then finally, again, we touch the upper Bollinger Band somewhere here, and then again, we see a reversal of the price here. Touch the lower Bollinger Band, it goes on for a few data points, and then again, there is a reversal. It is hard to see a point where it sort of crosses the Bollinger Band and keeps going, which means that it is true that the Bollinger Bands are a reasonable points where we might assume a price to reverse. But that doesn't always mean that we are going to make a profit if we were to sort of use that as an indicator. For example, here we touch the lower Bollinger Bands and we take a trade here, which is in green. We enter a trade, but this trade ends in a loss because we never hit our take profit percentage, and this is in general the direction of the stock is in a negative direction, we're making sort of lower lows, and then we sort of get stopped at around here. So that's something to remember about Bollinger Bands. In general, it is true that Bollinger Bands are indicative of a reversal, but whether we can make profit from the reversal is not as simple as that. So let's come back to coding the Bollinger Bands now. So in order to write a code for the Bollinger Bands, again, most of our videos start off with a similar data set where we look at Bitcoin data at 5-minute intervals. And you can also download the link to the data in the description below. And so, and to define the Bollinger Bands, first we have to define the window, which we define as 20, which is a typical period, but it's something you can play with later. And then we define the 2 standard deviations, again, something you can play with. You can think about 2.5 or 3 standard deviations, for example. So we calculate the SMA by looking at the close price and then using a rolling mean. So this is really important to shift it by 1 because you do not want the information about this particular candle to influence the Bollinger Band. The current candle is not completely drawn when we are making the decision to take the trade. So we only have information till the previous candle. So it is important to use only the previous data in order to calculate the mean. And same for standard deviation. So we calculate the rolling mean and the rolling standard deviation, and we define the upper Bollinger Band by mean plus multiplier multiplied by the standard deviation, and similarly for the lower Bollinger Band. Now we use our backtesting library, which I will link to in the description below. I have a whole video on how we sort of defined our backtesting library. But we say that we start with a cash of 80K, which roughly would allow us to buy 1 Bitcoin at the prices defined here around 65K. And then we have a profit and the loss percentage which is fixed at 1%. So we are going to enter a trade when we touch the lower Bollinger Band. That is our rule. We're only going to do long trades here. So we're going to enter when we touch the lower Bollinger Band, and then we are either going to take profit at 1% or going to be stopped at minus 1%. When we run this backtest, we find that our returns are negative, but they are still better than buy and hold. Our win rate is 3 out of 7, so less than 50%. And then these are the trades we took. As you can see, we were doing well when the stock was going up, and then when we have lower lows, we sort of hit the stop loss here. Especially when we sort of go down here, the Bollinger Band sort of cannot keep up very well, and we hit a lot of losing trades in this particular region. So I will talk a little bit about what I think about this strategy, but let's look at another version of this strategy. In this version, this is a variable version of the strategy where I take the profit and the stop loss based on, which is not fixed, but based on the Bollinger Band itself. And again, this leads to a slightly better win rate of 51%, but it takes way more trades. Again, return is better than buy and hold, but still negative. And I think it does a little better in this area where we have a sudden sort of breakout of the price. So let's look at what happens in these strategy class definitions. So if you're familiar with my backtesting library, the library sort of says when to enter a trade, which is the most important thing. So this run function says when to close a trade, which is, fixed stop loss and take profits. But in the random strategy, we enter a trade if a random variable is 1. And this is the command to enter a trade. In the Bollinger Band strategy, we define an entry signal as true if the low of the current candle is lower than the lower Bollinger Band, which is our sort of long entry signal, and then we buy. with a fixed stop loss and take profit, which is defined here in the initialization of the Bollinger Band strategy. Now in the variable Bollinger Band strategy, we look at the width of the Bollinger Band. We take a stop loss or a take profit based on how wide the Bollinger Bands are compared to the price. So if the Bollinger Bands are very wide, at that point we can take a large take profit and the stop loss. If the Bollinger Bands are very small, we can take a small take profit and stop loss. So finally, what do I think about this strategy? So I think Bollinger Bands, using only Bollinger Bands is probably not going to give you a winning strategy. They are an okay strategy when the market is upward or even sideways. But if the market is falling, especially somewhere like this, when you have sort of a breakout in the wrong direction, or you have lower lows, this is when the Bollinger Band strategy is not going to work for you. So in some of my previous videos, I have tried to estimate the trend using a simple moving average, and that may be a good idea to add to a strategy like this. And finally, I think that we do see reversals when we hit the lower Bollinger Band, and we might be able to be more clever on how to take advantage of these reversals by using a proper take profit and a stop loss, which was my sort of attempt with the variable take profit and stop loss, but that may be something we can improve on. There are some variants of the Bollinger Band strategy. There is a popular YouTube video which talks about using the RSI in combination with the Bollinger Band strategy. That is something that I do want to test out in a future video. So look out for that video to come, and then we will see if that does better than simply using Bollinger Bands. Thank you for listening to this video. And basically what we learned from this video is that Bollinger Bands as a strategy is easy to code, but it may not be as a single indicator, it may not give you a winning strategy, but we can combine it with other strategies, and we have some intuitions on how to combine it with other indicators in order to form a winning strategy.